A warm welcome to all the smart investors and curious mind tuning in. I appreciate each one of you joining me on this video to dive into another week ahead market analysis. This week is one of the important forex week and we can get some clues from the Federal Reserve, ECB and UK Central Bank. Traders need to check economic clues and find out when the central bank start to cut interest rate. Any data that can determine this conclusion more quickly is on the trader watch list. Let's check what news will be published for the US dollar this week and what impression they leave on the US dollar. On Monday, we have manufacturing index of the Federal Reserve of Dallas. On Tuesday, the consumer confidence index as well as job data. The data is the inflation forecast for the US. An increase in production and an increase in consumer confidence are both indicator of commodity consumption, which will be expected to increase inflation. Tuesday job opportunities will have more impact on the dollar price, and better data will push back expectation for interest rate cut. And we also have ADP data on Wednesday. In the January reports, an increase in this report would indicate more job, and more job would mean more family incomes, all of which would be increased inflation. Let's check the central bank table and decision schedule. The reason for the importance of this data can be seen in the decision of the Federal Reserve on Wednesday. It will be start on Wednesday at 19 London time. Because according to the expectation of the Federal Reserve, it is expected to keep interest rate at 5.5%. However, the data can clarify or prediction of the Federal Reserve tone of waiting and keeping rate for a longer time or starting to cut interest rates sooner. It is far from expect that will be that will decrease or increase the interest rate. But what matter is the tone of the Fed and their decision going forward. And back to the calendar page, Federal Reserve the monetary meetings on Wednesday will not have the final words in determining the direction of the US dollar, as the latest non-farm payroll report is due on Friday, which is usually seen as a big move in the markets. Despite fear that higher interest rate will lead to widespread job losses, a soft landing in the labor market now appear to be taking shape, which almost means the same for the US economy. After unexpected warming up in December, the labor market is likely to cool down in January. It is expected that 162,000 new jobs were created in the US economy compared to 260,000 in the previous month. The unemployment rate is also expected to remain unchanged at 3.7%, and average hourly earning are expected to moderate at 0.3% monthly pace in January. Jump to the European data. Eurozone data next week may present policymaker with a combination of negative economic growth and limited progress in reaching the 2% inflation target. According to the definition, when economic growth is negative for 2 quarters in a row, the economy may be in a recession, and if the European GDP data is published in expectations, we can say that the possibility of the recession in European become stronger. Let me show you the Eurozone economy index on the comparison page. What we have is lower inflation, lower than previous retail sales, lower consumer confidence, and also lower GDP than previous number. For historical GDP, we have low and lower GDP prints in a row, which is significant sign of recession. For the euro, we had the central banks meeting last week, which disappointed traders with interest rate decision, and the euro is still in the weak zone. In this week, which is considered a busy week, we will have the economy data for the economic growth of France and Germany on the Tuesday. The Eurozone is going into a recession, and if these data are released worse than expected, it can increase the pressure on the Eurozone to start lowering interest rates. On Wednesday, the German economy is on the table, and the index of food sales, unemployment rate, and inflation rate will be published, and attracting the attention of traders because if the data is published worse than expected, the sign of recession in the euro area will be more visible than before, and we predict a sharp decline for the euro. On Thursday, we will have the inflation of the euro, and on the same day, the speech of the members of European Central Bank. And now it's the BOE turn. The Bank of England will meet on Thursday for the first time in 2024. Like the Federal Reserve and the European Central Bank, the Bank of England is expected to keep interest rates unchanged because while UK inflation is on a downward trend, it remained well above the 2% target. However, the upcoming monetary meetings could be an important moment in the Bank of England's efforts to fight inflation, possibility leaving its hawkish stance. The Bank of England, three monetary members who have persisted in supporting interest rate hike even after the monetary tightening cycle stopped in September, may also change their stance. The Bank of England has taken a step that may indicate a potential decrease in interest rate in the future. This move come after a decrease in consumer prices index in October and November. By doing so, they hope to reassure investors that they won't follow an aggressive approach like the Federal Reserve and the European Central Bank when it comes to cutting interest rate in this year. It is also important to mention that Andrew Bailey has been quite clear recently about his belief that interest rates should remain higher for a longer period. However, it is not likely that he will surprise the market with any unexpected action. But if the bank's updated economy forecast suggests that inflation will ease toward the 2% target faster than previous expected, policymakers may reconsider their focus on keeping the monetary stance tight for an expected period of time. Looking at the UK economy data, the pressure on the pound is clearly visible. Reduction of inflation, the decrease in the retail sales index in both the monthly and annual dimensions, the decrease in the consumer confidence index, and the decrease in economic growth GDP. In fact, with this data, speculations about the dovish tone of the Bank of England will increase. And now let's take a closer look at the smart money review and the COT reports. The first thing that caught my attention is the change in the 10 years US bond yield contracts. What I noted is that there have been 105,000 more contracts to the net buying position of these assets. Here are the details. 58,691 buying positions were added, while 46,000 selling positions were closed. This could indicate some power again for the dollar this week because traders and speculators buying 10 years bond yield in the future market that shows they sell bond or notes in the future often suggests a lack of the confidence in the US dollar. The Japanese yen has decreased significantly due to central banks of Japan stepping back from its hawkish policy. A substantial number of 14,000 contracts were closed for buying position. Risk assets like the Australian dollar stocks have all seen a decrease in their positioning. On the other hand, the Canadian dollar has seen growth mostly because there have been fewer selling transactions rather than an increase in buyers. There haven't been significant change in figure of other asset except for oil, which has seen a decrease of 27,000 sale contracts. This reflects concern about the future stability of the oil market. Lastly, gold has experienced downward pressure with the closing of 21,000 contract. Although gold might see some growth in this week, it's important to pay close attention to the fact that central banks are increasingly forecasting interest rate reduction. Consequently, smart traders and investors may choose to shift their asset from gold to more profitable options like stocks. This might mean we shouldn't expect high gold prices in the near future. This video is end and I am thankful for your time and to watching this video. We will be in touch soon.